Good afternoon, everyone. In today's video, I'd like to talk about two different things. The first is going to be a setup in DataDog. Here, this is a more of a swing trade sort of setup here, but I'll talk about what I think are potential target zones that you may be looking at on DataDog, looking to try and play not only this daily move and this daily squeeze along with the daily bullish edge signal here, but also if we take a look at this on a weekly time frame chart, we have a pullback to our market pulse line in what we expect to still be something that ultimately fires long. So we'll take a look at that setup in a little bit more detail, and then we'll switch gears to the S&P 500, taking a look at a couple trade ideas that we had today. One was a Futures Volatility Box trade. This was looking for a fade of a reversal zone, and then the second was based off of the market internals with the cumulative tick based off of what it was telling us in the morning, along with where it ended the day in terms of what we can expect for tomorrow, or at least what would be likely to happen. All right, so first starting off with DataDog here. Again, this weekly time frame setup looks very interesting. Overall, we are looking at this bullish edge signal, which so far looked like it was really starting to fire long. The squeeze has yet to still fire. We're now making a pullback to what would be a very interesting period in terms of the market pulse line, where it wouldn't be all that unlikely to really see us now start to break above and hit that final remaining extension in this swing, this previous swing of that 200% zone, and then also then overshooting a little bit, taking us to that 1272, both of which are around 125 and 130. That I think would be my ultimate target in Datadog. However, along the way here on the daily time frame chart, I expect that the first zone, for those of you that would like to take money off quicker, would be a test of this market pulse line. So that would be 94.62. This would be a place in which you can start to take off some money, especially if you're trading the actual shares here. That's actual realized dollars. And then one way that you may be looking at trying to play this is moving your stop to break even, looking to see how high does high actually become to try and avoid a period in which we come back down, break this, and retest again at that 50% zone. So I think that's based off of how much heat you're willing to take in Datadog, along with how much confidence you have in Datadog in terms of a longer term holding. Then the next period of resistance I think would be right around that 100 zone, which overlaps with the 50% retracement of the new swing high to swing low. And then once we clear that, I think the previous period would be the 115.30, and then if we can break above 115.30 and ultimately this 118.13 zone, then I'd be looking at a test of new all-time highs here at 125.38, along with 128.57, with this entire area acting like a zone in which the squeeze may take us ultimately to. So I think that would be the longer term idea here, where you can see obviously where owning shares gives you a little bit more flexibility in terms of managing this trade without needing to worry about things like data decay. However, if you were looking to try and craft an option trade here, let's take a look at a couple different ideas. I'll divide each of these target zones as two different potential areas in which we may have price action stop, which helps to determine the idea for the closer dated options expirations, along with the further dated options, playing different targets for each time period. All right, so starting off here, the first time period that I'd be looking at would be this 94.42, 94.62 retest of the market pulse line. So to me, that's the closest spread that makes a lot of sense here is the 95-100. So we come into the trade tab. This would be the closer dated options. So this is 25 days to expiration. You'll notice the expected move here is also 10 bucks. So it accounts for a move potentially up to 100. So those are a couple things I like about this cycle. In here, I'd be looking at a 95 and a 100 spread called debit vertical spread here. Currently going for $1.35. You'll notice if we scroll all the way down here, the IV percentile here is only 3%. So I think that makes me want to be more of a buyer of options, where this spread looks fairly interesting for 25 days to expiration, risking 135 to try and see if we can get a move up towards that 95 to 100 zone, which is currently out of the money. And then if we're looking at, say, the next target here, which we said was closer to that 115 area, looking for new all-time highs, then we can come out here, buy some more time into January, look at something like, say, the 115 and the 120, which is currently going for 45 cents, looking to see if we can get that really extra move that is unlikely, at least priced according to the option chain here, right? So 91 plus the 15 would be something like 106, and we're clearly expecting pricing to go even above 106. If you are looking to try and come down a little bit, that's where you could use something like, say, the 105 here and the 110. Also has fairly high open interest, and that's currently going for 85 cents, so not that much more expensive to come back inside of the zone in which the expected move now allows for pricing. So those would be the two trade ideas there, based off of if you'd like to trade in the December options series or the January option series, that I think would be fairly interesting to play this move if you don't want to trade with shares. Now, if we switch gears to the S&P 500 here, I'll load in our 1-minute chart. And let's start off with our Scalper Volatility Box. All right, so starting here in the morning, the S&P futures had tagged the upper bound of our Scalper Volatility Box, and then we bounced away from there. So these levels were respected. You again had the belief that the Scalper Volatility Box model is the one that's respected. Then again, we bounced into our sign entry line here, and from that period, again, bounced up higher. We're looking for an edge signal confirmation and then a retest of the sign entry line as our futures trade. So far, this first hour is just observing, and then the second breach here, which was respected, we never really got an opportunity to enter. Now comes the next hour, which is the 8 to 9 a.m. Pacific hour, in which we did have a breach of our sign entry lines right here. We then got the edge signal as well, and then we had plenty of opportunities to enter at the sign line or better, and the entry was right here. The risk was 3.5 points minimum, and you're looking for that same 3.5 on the opposite side. Now, this is where using the actual futures contract really kind of worked against us today, where we went right outside of the volatility box and we tagged outside of our stop before ultimately reversing and giving you what would have been the target. Here, SPY calls would have obviously given you a slightly better opportunity to stay really within this extra move outside of the clouds. You just have a little bit more tolerance built in if you have a max potential risk. However, using futures here, this was a stop out and this was a loss of 4 points, not 3.5. 3.5 was the bare minimum risk. So it gave it a little bit of buffer room even outside of the box. That was still taken off at 4 points. And then we saw this reversal. So that was a little bit frustrating to see. Once we ended up going outside of the clouds here, that was then our sign to switch over from the scalper to the aggressive volatility box. We come into the aggressive, you'll notice that sign line's respected. So we've now been able to adapt to volatility. Again, looking for the same sign lines to be breached, which only happened really in this 3-hour open where again we've hit the scalper. But for after hours, I think you probably want to stay on the doomsday aggressive and onwards, looking to be a bit more conservative. So no other trades in the S&P via the volatility box. However, the other trade that did set up was based off of the bullish bias that we expected with the cumulative tick indicator. In the morning, we need to expect it likely trending up, which is really saying that you should have an ultimate bullish bias looking for potential buy entries or buy triggers. And what I mentioned to all of our futures members in our note in the morning was an edge signal confirmation on the indicator via a 1 or a 3-minute chart. The first 1-minute signal came right here, right around that 11:30 period. For those that were trading options here, the SPY 357, which was the one that was closest to our price action here, that was still slightly out of the money, was going for 28 cents expiring today. By the time you ended up hitting 357, which was towards the edge of this 11 to 12 p.m. hour and this burst move up higher here, that option went up from 28 cents to 68 cents. So I thought that was fairly interesting and a really nice move that happened fairly quickly, right? The option fill happened. If I use the rectangle tool here, it was in this guy right here, this period of the zone when we had the edge signal confirmation, and the target was hit really right here when you actually tagged that 357 zone where these out of the money calls started to print fairly nicely going up to 68 cents. And then in terms of the max potential move that you saw in this period, that option ended up going, I believe, all the way up to something like $1.50 before then losing all of its value fairly quickly, given that this was a 0 days to expiration option. So this is where I think for those of you that are looking to purely day trade options, those 0 days to expiration are fairly interesting. And now finally, to conclude this video, we had the cumulative tick suggest a likely trend exhaustion. So this would be interesting tomorrow when we have price action open up on the S&P futures here via the indicator. We're on a 1 or a 3-minute chart. You get a bearish edge signal arrow in the morning. That's where I think would be fairly interesting to try and look at this using SPY puts. Again, with the closer days to expiration, looking to try and play a move in which you can get some of this price action happening fairly quickly in your direction. So again, that would be where tomorrow it wouldn't be all that surprising if when you open up you continue to have some sort of a move up higher, at least in the early parts of the morning. Then you'd be looking at a bearish edge signal here via a 1 or a 3-minute chart, looking to then try and play a potential reversal in SPY, where then that gives you what bias we have from here, which is at least some sort of a potential trend exhaustion tomorrow. All right, so hope this video helps with crafting a couple trade ideas in not only DataDog, but also a trigger tomorrow for the S&P, along with discussing the S&P futures trade that we had set up today via the volatility box, which was not a winner. And so I thought that made for a fairly interesting discussion where a lot of the trades, at least in the recent history, have given us our first targets right away. Today, that did not happen where we were stopped out, but price action still ended up reversing in the direction we were looking at, where the futures contract really took away a little bit of that flexibility, but that's just how I think the cards unfolded today. All right, hope this video helps. Take care, everyone. Good luck trading, and we'll see you in the next update.